Right now, Wall Street is preparing for August 12th. That is when the July Consumer Price Index is released, and investors are watching this one specific number to figure out exactly what the Federal Reserve will do next. To understand why this report is so critical, we have to look at the labor market. The latest data showed U.S. payrolls dropped by 23,000 jobs in July. Financial markets often interpret this kind of weak data as a positive signal. This chart shows how that works. As companies slow their hiring, wage pressure and consumer demand tend to cool off right alongside it. But there is a strict limit to that logic. If the economy slows down too fast, those falling employment numbers start eating into corporate earnings and choking off consumer spending. Investors are demanding a highly delicate balance. They want an economy that moves slow enough to bring prices down, but stays resilient enough to avoid a recession. That balance is currently being threatened by oil. Driven by renewed geopolitical tensions and uncertainty in the Strait of Hormuz, Brent crude has pushed sharply higher, recently trading in the mid to high 80s per barrel. When oil gets more expensive, the baseline cost to operate a business rises. Manufacturers pay more for raw materials, and airlines and shipping companies face immediate spikes in fuel expenses. Eventually, those rising input costs make their way through the supply chain until the bill reaches the consumer. This chart compares our current reality to the Federal Reserve's ultimate goal. We have consumer prices increasing at 3.5% and core CPI at 2.6%. Both sit stubbornly above the strict 2% target line policymakers want to achieve. So the United States finds itself in a highly complicated position, entering a window of slower job growth while directly colliding with renewed inflation pressure. The responsibility of resolving this contradiction falls entirely on the Federal Reserve. They have held the federal funds target range steady at 3.50% to 3.75% since early 2026. By law, the central bank operates under a dual mandate. They must balance maximum employment with stable prices. This animation shows the classic central bank dilemma. Normally, a weakening labor market gives policymakers room to cut interest rates. But loosening monetary policy to protect jobs risks causing inflation to accelerate again. Conversely, keeping interest rates high to crush inflation suffocates business demand, triggering widespread job losses. America is moving into a hostile environment where protecting the broader economy and fighting inflation require entirely opposite monetary strategies. To see how this dilemma impacts the rest of the country, look at the 10-year U.S. Treasury yield, which has been hovering near multi-month highs around 4.7. Here we see exactly how that plumbing works. When that central Treasury yield remains elevated, it directly increases the cost of consumer borrowing, making mortgages and auto loans significantly more expensive. High yields also choke off corporate borrowing, forcing companies to pull back on investments and halt expansion plans. It also shifts behavior in the stock market. When yields rise, safe government bonds suddenly look much more attractive to investors compared to high-valuation equities. An inflation spike directly reprices the American economy. It dictates the cost of buying a home, the ability to finance a car, and the actual value of a retirement portfolio. When the July CPI report drops, three distinct paths open up. In Scenario 1, inflation comes in softer than expected. This relieves pressure on the Fed, pushes Treasury yields down, and offers immediate relief to rate-sensitive sectors of the economy. In Scenario 2, inflation remains sticky and elevated.
The Fed loses its freedom to cut rates, meaning borrowing stays expensive and markets experience prolonged volatility. Then there is the third option. If inflation surprises significantly to the upside while oil prices remain elevated, the entire market narrative shifts overnight. Investors immediately stop asking when interest rates will fall and instead start asking how long rates will stay high. The danger of the upcoming CPI report is its power to totally reset long-term expectations. To make sense of this environment, you have to look past isolated economic headlines and watch the actual macro sequence play out. This diagram maps the macro sequence. Consumer inflation forces the Federal Reserve to react. That reaction dictates interest rates, which directly control borrowing costs. The loop finishes. Borrowing limits consumer spending. That drop dictates corporate performance, ultimately deciding market health and jobs. Financial markets operate entirely on changing expectations of the future. On August 12th, investors will get the data they need to adjust those expectations, setting a new course for U.S. interest rates and the broader economy.